Welcome to Week 9, Capital Budgeting and Cost Analysis. In this module, you'll learn how organizations evaluate long-term investment decisions, projects that span multiple periods and commit significant resources. We'll explore the 5 stages of the capital budgeting process, the 2 discounted cash flow methods, payback and accrual accounting rate of return methods, and how to identify relevant after-tax cash flows. Here are 6 learning objectives for the week. First, describe the 5 stages of capital budgeting. Second, apply and evaluate 2 DCF methods, net present value, internal rate of return. Third, compute payback period and discounted payback. Fourth, compute and evaluate the accrual accounting rate of return. Fifth, identify relevant after-tax cash flows. Finally, discuss implementation and the post-investment audit. Capital budgeting involves long-run planning for significant investments. Projects span multiple periods, so we analyze costs both horizontally, tracking each project over its full life, and vertically, rolling annual figures into each accounting period. These large, long-lived commitments require strategic alignment, because the timing of cash flows is critical. $1 today isn't equal to $1 5 years from now. The capital budgeting process has 5 sequential stages. First, identify potential projects aligned with strategy. Second, obtain information by gathering data across the value chain. Third, make predictions of all potential cash flows. Fourth, choose the alternative offering the greatest benefit at least cost. Fifth, implement and learn, closing the loop with a post-investment audit. Discounted cash flow methods are the gold standard for evaluating long-term projects. They discount each expected future cash inflow and outflow back to the present using the required rate of return, the minimum acceptable annual return, also called discount rate, hurdle rate, cost of capital, or opportunity cost of capital. We'll study NPV and IRR using this benchmark. Net present value measures the expected monetary gain or loss from a project in today's dollars. We discount every future after-tax cash flow at the required rate of return, sum them, and subtract the initial investment. If NPV is 0 or positive, accept the project and add value. If negative, reject it to avoid destroying value. Internal rate of return, or IRR, measures the project's earned percentage return rather than its dollar value. It's the discount rate that makes the value of cash inflows equal outflows, setting NPV to 0. Accept if IRR greater than or equal to required rate, reject if lower. Solved with a calculator or Excel's IRR function. Both NPV and IRR use discounted cash flows, but NPV calculates value in dollars, while IRR reports a percentage return. NPV assumes cash flows are reinvested at the required rate of return. IRR assumes reinvestment at the project's IRR, which can be unrealistic when rates are high. If they conflict, choose NPV. Every discounted cash flow model relies on forecasts, and forecasts can be off. Sensitivity analysis tests that uncertainty by adjusting one key variable, like cash flow, price, or the discount rate, across pessimistic, most likely, and optimistic scenarios. Recalculating NPV under each shows whether a project's acceptance holds or flips, revealing its vulnerability to assumptions. The payback method answers how many years it takes to recover the initial investment. For uniform cash flows, divide the investment by the annual inflow. With uneven flows, subtract each year's inflow until 0 and then calculate a partial year fraction. It serves as a fast screening tool when later cash flows are uncertain. Discounted payback discounts each cash flow at the required rate, and then tallies until the initial investment is recovered. It honors time value but still ignores cash flows after payback, and may reject profitable long-term projects. As with simple payback, treat it strictly as a screening tool. The accrual accounting rate of return, or ARR, uses accounting income rather than cash flows. Compute it as the increase in average after-tax operating income, revenue gains minus depreciation, divided by net initial investment. Many companies use average investment instead of initial cost, so verify which denominator applies. Comparing NPV, IRR, payback, discounted payback, and ARR shows only NPV and IRR satisfy cash flow focus, time value respect, and full project life. Standard payback ignores timing and post-payback returns. Discounted payback fixes timing but still stops early. ARR relies on accrual income without discounting, fitting performance reports but missing cash flow rigor. Only incremental after-tax cash flows matter in capital budgeting. First, the net initial investment. All upfront acquisition and preparation costs. Second, operating cash flows. Annual after-tax inflows during the project life. Third, terminal disposal and working capital recovery. Proceeds from selling the asset plus release of working capital at project end. Net initial investment combines three after-tax components. First, the machine cost. Invoice price plus transport, handling, installation, and readying costs. Second, the working capital outlay. Net increase in receivables, inventory minus payables. Third, the disposal of old equipment. After-tax proceeds or tax benefit on gains or losses. All components are measured net of tax. After-tax operating cash flow has two parts. One is net operating inflow, pre-tax cash flow multiplied by 1 minus tax rate. The other is the depreciation tax shield, depreciation expense times tax rate. Together, annual operating cash flow equals pre-tax CF times 1 minus T plus depreciation times T. At project end, include two cash flows. First, terminal disposal. Salvage proceeds adjusted for tax on gains or benefit on losses. Second, working capital recovery. Release of receivables and inventory generally non-taxable. Together, NPV equals minus initial investment plus PV of operating cash flows plus PV of terminal disposal and WC recovery. Ridgeline Furniture's equipment costs $100,000, has 4-year life, straight-line depreciation, $35,000 pre-tax annual cash savings, 25% tax rate, and 10% discount rate. After calculating $32,500 annual after-tax cash flow, discounting yields PV of $103,022. Subtracting the investment gives NPV of $3,022. Decision: accept. A $6,250 depreciation tax shield pushes the project over the line. Stage 5 kicks off implementation and management of the chosen project, followed by a post-investment audit that compares actual performance against initial expectations. This feedback loop refines future decisions. All actions should align with strategic goals. Beware misaligned incentives. Rewarding short-term accrual income can lead managers to reject NPV-positive projects. Review question. If the present values of all cash flows for a proposed capital expenditure, discounted at the required rate, sum to a positive number, what does it mean? A. Max you should pay. B. Wrong discount rate. C. Best option. D. Return exceeds required rate. Pause and think. Answer. D. A positive NPV at the required rate of return means the project earns more than the hurdle rate. That's pure value creation. Option A is a distractor since NPV shows value added, not the max price you'd pay. Option B is irrelevant, and C confuses acceptable with the best alternative. Answer. D. Only the IRR method assumes cash flows are reinvested at the project's own IRR. NPV assumes reinvestment at the required rate of return, the firm's hurdle rate, which is more realistic. Assuming a high IRR reinvestment rate is often unrealistic. That's why NPV is generally preferred when IRR and NPV conflict. Review question. Which features does the simple payback method consider? Does it account for the time value of money and income over the project's entire life? A. Both. B. Time value only. C. Full life only. D. Neither. Pause to think. Remembering this is simple payback. Answer. D. Simple payback considers neither the time value of money nor income beyond the payback period. It simply measures how long it takes to recoup the initial investment, treating all cash flows equally. Note that discounted payback does account for time value, but this question focused on simple payback. Trailhead here invests $60,000 in method follows 5 stages. Year 1 returns $20,000 info remaining for external rate. Choose and implement. Neither IRR nor discounted cash flow methods are the gold standard time value analysis. Year 3, a $30,000 NPV covers the investment assumption. The partial year payback methods are screening tools. 000 divided by $30,000. Yields conduct post-investment making payback 2.5 years. This method ignores time value and later cash flows.